Welcome to another episode of Quest for Twice. Today is May 14th. Today I'm going to cover the earning updates from several companies in my portfolio. The first one is Kinder Morgan. So as usual, Kinder Morgan delivered a fairly boring earning update, which is good. It reiterated the 2024 EBITDA budget of $8.2 billion. So with a net debt of $31.9 billion and a market cap of $41.5 billion, its EV over EBITDA is about 9.0. It's a little more expensive compared to 3 months ago because of the stock price went up. Its a full year DCF is still at $5 billion. So with the $2 billion of capex budgeted in this year and a forward dividend of $2.57 billion, there is still going to be about $300 million of free cash flow left. Equifax also reported the earning. Its first quarter revenue was up 5% on constant currency basis without the contribution from acquisitions. The non-mortgage organic revenue was up 9%, same as previous quarter. The EBITDA margin was 29.1%, about the same as 1 year ago, and a drop from fourth quarter 2023. Its mortgage revenue was up 6%, despite the 19% fewer mortgage increase year-on-year, and gave a second quarter guidance of revenue up 8%, with a 32% EBITDA margin. The full year revenue guidance was unchanged, with a 33.3% EBITDA margin. So overall, pretty healthy first quarter, but nothing spectacular. Now let's look at its growth drivers. Its cloud transformation is going well, with 90% revenue in the cloud by end of this year. Its vitality index was 9% in the last quarter, a drop from 14% and 15% in previous 2 quarters. So that's something worth of watching. Its workforce solutions faced a headwind from hiring freeze, but still growing records, as shown in the chart on the top right. And there was no update on the M&A front. Now let's look at the MarineMax. Its fiscal second quarter revenue was up 2% year-on-year, with 2% same-store growth. However, its gross margin was down 250 bips because of a higher level of promotions. However, its gross margin was still above 30% despite the higher promotion level. So looks like its gross margin will stay above 30% from this point going forward, comparing to a little over 25% before the pandemic. As I mentioned before, that's most likely because of the higher sales contributions outside boat sales, especially storage and charter segment, as shown in the figure on the right. Now let's look at the quarterly revenue in details. As shown in the figure on the top right, it's boat sales. Those are the 3 lines on the top, show strong seasonal pattern, with the overall boat sales higher than 1 year ago, although new boat sales was actually a little less. What's standing out is the storage and the charter business, with a new high over $45 million in the last quarter. Its maintenance and repair, as well as parts and accessories revenues, were actually less compared to 1 year ago. So I would say its business is on shakier ground comparing to 1 year ago. Now let's look at profitability. That's shown in the figure on the bottom right. The adjusted EBITDA was significantly less from 1 year ago. It was almost $24 million in the second quarter, comparing to $52 million 1 year ago. That big decline was because of the compression of the gross margin, as I mentioned earlier, as well as to some degree higher floor plan interest payment. Of course, even I added the interest payment and the stock compensation costs back. Its unadjusted EBITDA was $40 million in the last quarter, compared to $62 million 1 year ago. So that's a still significant drop. That shows MarineMax's business was impacted by the high interest environment, which suppress demand as well as increase its interest cost. Lastly, let's look at the INMD, which had a disappointing first quarter. Its revenue growth stood in last year, as shown in the middle figure on the right. That was because of the higher interest rates. And this year, the management revised its full year revenue guidance down. So it will be about flat compared to last year. And even worse, the first quarter revenue declined 24%. That's because of the company was rolling out 2 new platforms. So the potential buyers were holding and waiting the new equipment to be available. However, as we can see in the figure on the bottom right, Q1 last year was actually weak compared to the rest of the quarters last year. So Q1 this year is weaker than the weakest quarter in last year, which is not a good thing. However, the management did approve a buyback of 8.4 million of shares, which is about 10% of the total outstanding shares. That's a signal that the management believe its current stock price below $20 was too low. The company has a lot of firepower in terms of cash equivalent on its balance sheet. At the end of first quarter, the cash equivalent amount was about $770 million. So with the purchase of $8.4 million of a share, it will only use a small portion of its cash on its balance sheet. It has a lot of firepower to defend its stock price. This concludes this episode of Quest for Twice. Until next time, happy investing.